Welcome back to Neuramyth. Today we are examining the mechanics of the American credit score, a 3-digit number with an engineered history and specific hidden functions. Have you ever felt that knot in your stomach right before you check your credit score? You hold your breath, your heart races, and for a split second you feel like an algorithm you don't even understand is judging your worth. Imagine you do everything right. You live within your means, pay in cash, and refuse to take on debt. In the United States, that behavior makes you an economic ghost. Right now, 45 million Americans are credit invisible or unscorable, systematically locked out of the modern economy because they refuse to participate in a cycle of debt. The paradox deepens when you actually play their game. If you make every payment on an installment loan for years and finally pay it off, your score often drops by as much as 40 points. You are penalized for successfully eliminating your debt. The credit system actively punishes the exact financial responsibility it claims to reward. This 3-digit number serves as a rigid, invisible gatekeeper for your basic survival needs. Up to 90% of landlords use credit history for tenant screening. If your score falls below a 620, automated algorithms routinely reject your application before a human being ever sees it. You could have a year's rent in cash and still be denied a roof over your head. Scores below 660 funnel consumers into the subprime auto loan market. High interest rates multiply the lifetime cost of transportation, adding a heavy financial burden to the most vulnerable drivers. This diagram compares the cost of state-mandated auto insurance for two safe drivers with identical records. The driver with a poor credit score pays an average of $1,012, while the driver with excellent credit pays $470. A mathematical score, not your driving ability, dictates your premium. The score also impacts your livelihood. Roughly 60% of employers use credit background checks to screen candidates. This creates a cycle where damaged credit leads to job rejection, which in turn prevents you from repairing your credit. The score functions as a psychological tether and a mechanism of widespread socioeconomic exclusion. We treat the credit score as a permanent law of economics, but it is a recent corporate invention. Before 1989, lending was localized through manual underwriting. Bank managers evaluated your character, a subjective system that historically excluded minorities and required married women to have a male cosigner to maintain an account. Shadow organizations were already building the foundation. As early as 1899, the retail credit company, now Equifax, built invasive dossiers on citizens' private lives, tracking social habits and political views to sell to lenders. Bill Fair and Earl Isaac founded FICO in 1956 to replace human evaluation with predictive algorithms. However, the general-purpose FICO score used today didn't launch until 1989. The internet predates the credit score. In 1995, Fannie Mae mandated FICO scores for home loans. This requirement transformed a private company's predictive product into an unavoidable economic law. The Big Three, Equifax, Experian, and TransUnion, operate as multi-billion-dollar data brokers. They harvest your financial transactions and public records to sell your dossier to financial institutions. The FICO formula rewards specific debt behaviors. Due to component weighting, you cannot achieve a top-tier score simply by using cash. The algorithm requires you to maintain credit accounts and juggle installment loans, mathematically rewarding active borrowing. Gamified tools like Experian Boost promise to raise your score in exchange for real-time surveillance of your private bank accounts. You trade your financial privacy for a minor digital dopamine hit. From corporate gamification to video games for children, these tools condition the public to view lifelong debt management as a marker of personal success. We can break down the legitimacy of this system with 6 facts. Secret 1. The debt payoff penalty. Your score drops when you eliminate a loan because the algorithm prioritizes your ongoing profitability to lenders over your actual wealth. Secret 2. Trigger leads. The moment you seek a loan, bureaus package your private financial intentions and sell your contact information to the highest bidder in real time. Secret 3. Massive error rates. A Federal Trade Commission study confirmed that 1 in 5 consumers has a confirmed error on their credit report. Secret 4. The dispute black hole. Corporate relief rates for consumer complaints have plummeted. At Experian, the rate of resolved complaints recently dropped to less than 1%. Secret 5. The employment screening myth. In sworn testimony, a bureau representative admitted there is no statistical correlation between a credit report and job performance. Secret 6. Corporate lobbying. The Big Three spend millions of dollars in Washington specifically to keep consumer complaints hidden from public view. These facts reveal a system engineered to protect corporate revenue channels rather than protect or accurately represent the consumer. If this information is helping you see the system clearly, please like the video and subscribe to Neuramyth. Share this truth with someone who needs to hear it, and let me know in the comments which system you want me to expose next. An 800 credit score represents a highly predictable debtor, someone who reliably transfers a portion of their income to banking conglomerates as interest every month. While we must participate in this system to survive, we do not have to accept its proprietary rules as a measure of our personal value. True financial freedom begins by recognizing the credit score as a mechanism of surveillance and corporate control. Stay curious, question the system, and I will see you in the next video on Neuramyth.